Vladimir Sergeyevich Kim was born on October 29, 1960, a name that, by the early 21st century, had become synonymous with Kazakhstan's modern mining boom. From a modest start in the Soviet-era Kazakh SSR to the apex of a natural resources empire, Kim's rise reads like a case study in timing, technical skill, and the high-stakes deal-making that defined post-Soviet privatization. This is the story of how a civil engineer turned corporate tactician built one of Central Asia's most powerful mining empires, and how his choices reshaped the copper map of a nation. He trained as an engineer. After graduating from the Alma-Ata Architectural Institute in 1982 with a degree in civil engineering, Kim added formal business study later in life, an MBA and a doctorate in business and administrative management, credentials that would serve him well when the industrial landscape around him began to shift. The collapse of the Soviet Union opened doors for those who could read the new rules and move quickly. Kim read them with uncommon clarity. He entered the mining sector in the mid-1990s and, in the next decade, rode a wave of privatizations, foreign partnerships, and corporate restructurings to a position of extraordinary influence. Kim's first major corporate role came in 1995 when he joined Zhezkazgansvetmet JSC, a core subsidiary of what later became Kazakhmys. He was appointed managing director and then, in 2000, chairman of that subsidiary. Those early years were formative. They tuned him to the operational realities of large-scale mining and taught him how to navigate Kazakhstan's emerging corporate governance environment. In 2005, when Kazakhmys listed on the London Stock Exchange, Kim had climbed to the top of the company, chairman of the board, and the firm he helped steer would soon be recognized internationally as one of Kazakhstan's preeminent metal producers. But Kim's influence was not limited to a single firm. Over time, he became the pivotal figure behind a constellation of assets and holdings that would later be concentrated under the KAZ Minerals banner. Under his stewardship and in partnership with other managers, the group focused on large, open-pit copper projects that required deep pockets, patience, and a tolerance for commodity cycles. Bozshakol and Aktogay, two of the most important copper deposits in Kazakhstan, became centerpieces of that strategy. These were not mere mines, they were industrial ecosystems, huge pits, large processing facilities, and the logistical chains needed to move concentrate to market. The scale and ambition of these projects signaled a shift from opportunistic extraction to industrialized, export-oriented copper production. Kim's approach combined technical operational knowledge with an ability to structure complex corporate transactions. In 2005, a management buyout, a high-visibility move that involved selling a large stake tied to foreign investors such as Samsung, reflected a broader pattern. Over the following decade, the corporate map was redrawn repeatedly. Restructurings, asset transfers to privately held companies, and strategic shifts that concentrated higher-grade assets into a focused mining player. The public face of that strategy was KAZ Minerals, a company that through listing and later corporate maneuvers became the vehicle for the concentrated copper business that defined much of Kim's fortune. Corporate restructuring in resource sectors can be messy, technically advanced, politically sensitive, and financially intricate. Kim navigated that complexity by forging partnerships, making targeted divestments, and sometimes shifting assets between public and private entities. On several occasions, mature or non-core assets were moved to privately held companies linked to management. On other occasions, the group folded high-growth assets into the core public vehicle. For observers, this pattern illustrated a pragmatic, sometimes aggressive model. Shed what gives you low returns, invest in what scales, and find ways to capture more of the upside. For Kim, the result was an increasingly concentrated ownership of high-quality copper reserves and a controlling economic stake in the mines that would drive production and cash flow for years. That concentration of control evolved further in 2020 to 2021, when Kim and his longtime colleague Oleg Novachuk agreed to take the company private via a buyout consortium. The transaction reflected both the maturity of KAZ Minerals as a pure-play copper company and a strategic decision by its leadership to reorganize ownership behind a privately controlled holding company. Documents tied to that transaction show an ownership split in which Kim, through indirect structures, held a substantial controlling economic interest in the consortium that acquired the company. The exact percentages and mechanics are dense and legally sophisticated, but the upshot was clear. The leadership that had built KAZ Minerals consolidated economic control and moved the company into a different governance posture. Net worth estimates for Kim have fluctuated with commodity prices, corporate valuations, and the vagaries of public markets. Different lists and indices have placed him among Kazakhstan's wealthiest individuals for years. Depending on the source and the year, estimates have ranged from the low billions into higher single-digit billions. Those variations are hardly surprising. His wealth is largely tied to the value of copper assets and the companies that control them, variables that shift with global markets. Still, regardless of the precise figure, Kim's standing as one of the country's richest and most influential business figures is widely recognized. Where Kim stands out is not simply in raw capital, but in the industrial footprint his companies have left behind. Bozshakol and Aktogay are not marginal operations. They are major contributors to Kazakhstan's mining output and to the country's export revenues. The focus on large, open-pit copper, an essential raw material for electric infrastructure, industrial equipment, and increasingly, the green energy transition, positioned his group to benefit from long-term trends in commodity demand. This was not short-term speculation. It was the construction and operation of major mines that required long lead times and large, sustained capital investment. Kim's influence also extended into the structure of Kazakhstan's broader resource sector. Through shareholdings and board positions, he became a central node in the network of companies that dominate regional mining. That influence drew both praise for driving industrial development, creating jobs, and professionalizing large-scale mining projects, and scrutiny, common for any concentrated industrial group in a country where politics, natural resources, and business are often intertwined. It's also worth noting the public and journalistic scrutiny that often follows opaque ownership patterns in resource-rich states. Like many business leaders in the post-Soviet space, Kim has been associated with complex holding arrangements and offshore structures that are frequently used in global resource industries for legitimate tax, regulatory, and financing reasons. These structures can also fuel speculation and investigative interest. Public reporting and research have highlighted the complexity of ownership and control in some Kazakhstan-linked companies. For the curious viewer, the takeaway is twofold. First, that big natural resources businesses often employ complicated legal and financial architectures. And second, that transparency debates around those structures are ongoing and important for governance and accountability. On the corporate side, Kim's management style combined a technical understanding of mining with a willingness to make hard portfolio decisions. Moving mature assets out of the public vehicle or concentrating higher-margin copper projects under one umbrella were pragmatic moves aimed at efficiency and returns. The buyout and subsequent private control can be read as the next phase of that pragmatic approach. When management believes a company's best future lies under more centralized control, they sometimes act to secure that arrangement. For shareholders and markets, such moves require careful valuation and negotiation. For operators, they can streamline decision-making. Kim's personal life is deliberately low profile. He is reported to be married with several children and to reside in Almaty, Kazakhstan. That private posture is consistent with many business figures who prefer to keep family life out of the headlines, even as their corporate decisions shape national industries. What about legacy? Vladimir Kim's legacy will likely be measured in multiple ways. On one hand, there is the concrete legacy: huge pits and processing plants, thousands of jobs in mining towns, and billions in export revenue tied to the copper projects developed under his watch. Those are infrastructure legacies that change regional economies, create supplier networks, and anchor industrial communities. On the other hand, there is a governance legacy: a corporate playbook for privatization, consolidation, and strategic asset concentration that other regional players may emulate. That combination, industrial success and a model of corporate organization, will shape perceptions of Kim for many years. The story of Vladimir Kim also gestures toward the broader arc of Kazakhstan's economic maturation. In the 1990s, the country was an untapped map of resource potential. In subsequent decades, business leaders like Kim converted potential into production, negotiated with global capital, and integrated Kazakhstan's output into international commodity supply chains. Those efforts were not without controversy, and the interplay between business, politics, and national strategy remains a live question in Astana and Almaty. But the sheer scale of transformation, from Soviet industrial relic to a modern mining sector, owes a great deal to the managers and entrepreneurs who had both the technical know-how and the appetite for large, multi-year projects. For audiences trying to understand what made Kim successful, a few practical elements stand out. First, technical competence. His engineering background gave him an operational literacy that many purely financial operators lack. Second, timing and opportunism. The post-Soviet transition created windows for decisive actors to acquire and restructure assets. Kim took advantage of those windows. Third, strategic concentration. Rather than diversifying into many small bets, he focused on building scale in copper, a commodity with persistent global demand. Fourth, dealcraft. The management buyouts, partnerships with international firms, and later privatization moves owe a willingness to use complex financial and legal tools to shape ownership and control. But any full account also notes limits and responsibilities. Large-scale mining brings environmental, social, and governance challenges. Land use, water, worker safety, and community impacts are perennial concerns in mining regions. The companies Kim has led have had to grapple with these realities, not only to satisfy regulators and investors, but to maintain social license in regions that rely on mining for livelihoods. How well those challenges were managed is a mixed record in most large industrial operations, and they remain central to how any mining leader's long-term reputation is judged. As for the present and the near future, a handful of global trends will determine how Kim's projects and fortune evolve. Copper demand is projected to rise with the electrification of transport, the expansion of renewable energy capacity, and the broader shift toward low-carbon infrastructure, all of which require vast amounts of copper wiring and components. Commodity cycles will continue to produce volatility, but a company with large, high-grade open-pit assets is well-positioned to benefit from secular demand if it can manage costs and operate reliably. Meanwhile, geopolitical and regulatory shifts, especially those affecting cross-border investment, trade logistics, and environmental standards, will influence returns and valuations. In the end, Vladimir Kim's story is both a personal biography and a window into the industrial transformation of a nation. It is the tale of a technically trained manager who became a corporate architect, who steered assets through privatizations and public listings, and who ultimately consolidated control over one of Kazakhstan's most important mining platforms. Whether viewed as a builder of industrial capacity, an aggressive consolidator, or a cautious steward of capital, Kim leaves behind structures that will echo in Kazakhstan's economy for decades. For viewers fascinated by the intersection of natural resources, national development, and personal ambition, Kim's arc offers a clear narrative. Education and expertise opened doors, a tumultuous political and economic transition supplied opportunity, and a sustained focus on industrial scale and ownership control converted opportunity into lasting wealth. The copper pits and processing plants are the monuments to that conversion, physical reminders that, in resource economies, power often follows the places where the ground itself is richest.